In this video, I'll be talking about one of the best investment strategies of all time. Anyone can do it because it's easy and almost completely passive. And I have a great story to help me introduce it to you. So let's get into the video right now. Hey everyone, TJ Askew here and welcome back to my channel where I teach millennials about money. Today I'd like to tell you a story about a friend of mine, Warren. Warren. We go way back. Good times, good times. Back in 2006, Warren made a bet with the hedge fund industry that over the period of 10 years, an S&P 500 index fund could outperform a hand-selected group of hedge funds, and he was willing to bet $500,000 to prove it. Phew, chump change. But first, let's take a minute to talk about what an index fund even is. I'm sure you already know, but hey, let's just make sure the other viewers know what it is too, okay? An index fund is a portfolio of stocks or bonds that's designed to mirror the performance of the market or a particular sector. They're able to achieve this by holding the same assets as the broader market with the same proportions of each company as a percentage of the overall fund. Meaning it's just a smaller version of the whole market or sector so that investors don't have to go out and buy every single stock out there. Plus, one of the best parts is that index funds usually have very low management fees. Hedge funds, on the other hand, are the epitome of active trading. Their objective is to provide stable returns and outperform the market by utilizing various trading strategies for their customers. The other thing is that they usually charge really high fees for their services, the standard being 2 and 20, which is a 2% management fee and a 20% performance fee, aka they take 20% of the profits. Okay, so back to the story. For a long time, my friend Warren's bet didn't get any takers, but almost a year later in late 2007, this guy named Ted who works at Protege Partners decided to take up the challenge. And he created a diversified collection of hedge funds that he thought would easily outperform the S&P 500 over those 10 years. Meanwhile, Warren's index fund of choice was Vanguard's S&P 500 Admiral Fund, VFIAX. Once they were both ready, Warren and Ted put in their $500,000 each. That's $1 million bet. When the bet was publicly announced, Warren said,
Over a 10-year period commencing on January 1st, 2008 and ending on December 31st, 2017, the S&P 500 will outperform a portfolio of hedge funds when performance is measured on a basis net of fees, costs, and expenses.
So it was underway, the $1 million bet. But then, the Great Recession happened. The S&P plunged 34% in 2008, then dropped another 54% by March of 2009. Ted was licking his chops because in 2008, all of the hedge funds that he had selected were outperforming Warren's prized index fund. Luckily for my friend, things turned around and the market began to make a big recovery over the next few years. Here's what happened. As you can see, the S&P 500 significantly outperformed all of the hedge funds that Ted had chosen. So who won? The S&P 500 index fund strongly outperformed all hedge funds over the 10-year period of the wager, and here's why. Since the period was mostly a bull market, which is a good thing by the way, all the index fund had to do was passively hold its stock positions and watch them go up. Whereas the hedge funds had managers, aka actual people, that tried to take advantage of market opportunities as they came about. They were going in and out of positions, always seeking out winners, sometimes taking profits, using leverage, etc. And by doing so, they made a lot of mistakes. In the long run, all of these managers underperformed the market by a long shot. And to make matters worse, the high fees of the hedge fund really ate into investor returns over the 10 years. So Warren won the bet. In addition, he's a really good guy, so instead of taking the money, he donated it all to Girls Incorporated of Omaha, a nonprofit that provides academic, wellness, and leadership education for girls to be successful. To be fair, Ted had a charity in mind for if he won too. It was a feel-good story in the end, but the important thing is that there are some very important lessons to be learned here. Lesson number 1, it's extremely difficult to outperform the market. The top hedge funds in the world, with the brightest minds in finance along with hundreds of traders and investors, couldn't consistently outperform the market. So do you really think that mere mortals like us can do it? Lesson number 2, high trading activity lowers returns. The main reason for this is the trading fees. Each time you make a trade, you pay fees. And even with the advent of zero-fee brokerages, there are still fees associated with certain types of assets, and these have a negative impact on the return of your portfolio. And the worst part is, the more you trade, the more mistakes you can and probably will make. And lesson number 3, probably the most important and the whole point of this video, is that passive investing is the best choice for the vast majority of people out there. By passively investing in the market through something like an index fund, you'll outperform 99.9% of all actively traded funds, including some of the smartest and most successful managers in the financial world. Just let that sink in for a moment. Remember the fable of the tortoise and the hare? Well, let's take a moment to remember who won in the end. And in case you're wondering, the tortoise is index funds. I hope you guys found today's video both entertaining and educational. If you enjoyed it, all I ask is that you lightly press the like button for the YouTube algorithm. I'd really appreciate it if you did that for me. And please remember to subscribe if you haven't already for more videos about personal finance and investing. And you can even press the little notification bell so you get notified whenever I post. I'd love to connect with everybody on Instagram too, so you can find me over there if you want. Thanks again for watching, and until next time, this is TJ Askew, signing off. And for those of you watching who are not familiar with who this Warren guy that I've been talking about is, look it up first of all. And second of all, it's Warren Buffett, the pride and joy of Omaha, Nebraska, and one of the most successful investors in American history. So I'm pretty sure listening to him would be a pretty good choice.